Dividend investing is a strategy that appeals to both novice and seasoned investors seeking consistent income streams and long-term wealth building. Many people are drawn to dividend investing for its potential to provide passive income, but a common question arises: how much money do you need to start? Hello and welcome back to the Dividend Experiment, the channel that helps you build a portfolio that pays your bills. The content that we discussed is intended for information and educational purposes only and should not be considered investment advice or investment recommendation. Whenever you invest, your capital is at risk. In this video, we'll break down the costs, strategies and expectations surrounding dividend investing from a UK perspective, so you can determine how to begin this journey regardless of your starting capital. Firstly, what is dividend investing? Dividend investing involves purchasing shares of companies that regularly distribute a portion of their earnings to shareholders in the form of dividends. These payments are typically made quarterly or biannually, or sometimes monthly, and can provide a steady source of income. Popular examples of dividend-paying stocks in the UK include companies listed on the FTSE 100 such as Unilever, British American Tobacco and AstraZeneca. These firms are often referred to as blue-chip stocks, known for their reliability and history of stable dividend payouts. Dividend investing is attractive because it offers two forms of return. First, the capital appreciation. As the stock price rises over time, your investment grows in value. And then secondly, the dividend income, regular payouts that can be reinvested or used as cash flow. Setting realistic expectations. One of the first things to understand is that your starting capital will determine the scale of your returns. Dividend investing is a long-term strategy, and building substantial passive income from dividends takes time and consistency. For example, if a company has a dividend yield of 4%, investing £10,000 would generate £400 annually in dividends. While this may not seem like much initially, reinvesting those dividends and adding more capital over time can compound your returns significantly. So how much do you need to start? Starting with small amounts. Contrary to popular belief, you don't need a fortune to start dividend investing. Thanks to modern investment platforms like Trading 212, you can begin with as little as £1. Fractional share investing offered by some brokers allows you to purchase portions of high-value stocks. Starting small enables you to learn the mechanics of dividend investing without risking significant capital straight away, and also build confidence and discipline. Talking of Trading 212, I asked Trading 212 if they could give me a unique code that you guys can simply type into the promo code section. Capital at risk, terms apply. If you've opened up a new account recently or planning to open an account, then here it is, DivXP or DIVEXP. Short for Dividend Experiment. So you have 10 days from opening your account to type this in and receive free fractional shares worth up to £100. I also get something as this is my custom code, so this helps you support the channel too. If you do use it, thank you for your support, and thanks to Trading 212 for sponsoring this video. The ideal starting point. While you can start with small amounts, having a more substantial initial investment such as £1,000 to £5,000 allows you to diversify across multiple dividend-paying stocks and generate more meaningful returns from the outset. But how much do you really need? The amount you need to start dividend investing depends on your goals really, and the tools available to you, and your expectations. But here's a breakdown. The minimum to start. Smaller amounts of £100 or less, so you can start with as little as £100 or even less, and this is ideal for beginners who want to learn the ropes without significant financial risk. For the almost daily dividends pie, for example, the minimum recommended starting point is £400 in order to get the dividends from each of the holdings. The optimal starting point, £1,000 to £5,000. This range allows for better diversification and the ability to generate meaningful returns. So for example, at a 4% dividend yield, £1,000 would provide £40 annually in dividends, while £5,000 would generate £200. With diversification across multiple sectors, you reduce the risk of being overly dependent on one stock or industry. Larger investments, £10,000 or more. If you're looking for noticeable passive income from the start, £10,000 can provide around £400 annually at a 4% yield. This level also allows for a more robust and balanced portfolio that aligns with long-term goals. But before you start, you should build an emergency fund first. Before starting dividend investing, it's crucial to have an emergency fund in place. An emergency fund provides financial safety net for unexpected expenses like medical bills, car repairs, or job loss. Ideally, this fund should cover 3 to 6 months' worth of living expenses. Having this cushion ensures you won't need to liquidate your investments during financial emergencies, allowing your dividend portfolio to grow uninterrupted. This also means that the very first bit of cash that you invest shouldn't be in dividend stocks, but in something safer, like a high-interest savings account or a money market fund, which ensures liquidity and security. So if that £100 is the very first savings you have, you're not quite ready. It's only after starting the emergency fund that you become ready. I go into this in much more detail in the metronome video. What matters more than the starting amount? Consistency. Regularly adding to your portfolio over time is much more impactful than the initial amount. Even starting small and contributing monthly builds significant wealth due to the compounding effect. Dividend reinvestment. Reinvesting your dividends accelerates growth by using the dividends to purchase additional shares automatically. The more you get in dividends, the more you buy, then the more you get in dividends, and so on and so forth. In essence, you can begin dividend investing with as little as £100, but if you're looking for faster progress or meaningful passive income, aiming for £1,000 to £5,000 or more is recommended. The key is to start, stay consistent, and reinvest your earnings. Some factors to consider before starting. Dividend yield. Dividend yield is a key metric that indicates the percentage of your investment returned in dividends annually. It's calculated as dividend yield equals annual dividends per share divided by price per share. High yields are attractive but can sometimes indicate risk. Focus on companies with a track record of stable and growing dividends rather than chasing the highest yield. Diversification. Diversification attempts to minimize risk. Investing in multiple sectors such as technology, healthcare, and utilities protects your portfolio from industry-specific downturns. This is particularly important when starting with a small amount of capital, as it helps mitigate the impact of poor performance in any single sector. By spreading investments across diverse industries, you enhance the potential for capital gains in addition to dividend income. Starting with a well-diverse portfolio ensures that both the dividend and growth aspects of your returns are maximized over time, regardless of your initial investment size. Fees and costs. Choose brokers with low or no fees for dividend investing. Some traditional brokers may charge fees for both buying and selling shares, so you need to research thoroughly. The impact of fees can be substantial over time, especially when dealing with smaller portfolios. High fees can erode your returns, making it harder for your investment to grow. By selecting a platform with minimal fees, you ensure that a larger portion of your dividend income and reinvestment efforts contributes directly to your portfolio's growth. Over the long term, these savings can significantly amplify the compounding effect, accelerating the path to meaningful passive income. The power of reinvestment and compounding. Reinvesting dividends is one of the most powerful aspects of dividend investing. Each reinvested dividends buys additional shares, which in turn generate more dividends. Over time, this compounding effect can exponentially grow your portfolio. For example, if you have a starting investment of £10,000, dividend yield of 4%, annual contribution of £1,000 and a time frame of 20 years, with the reinvested dividends, this portfolio could grow to over £60,000, assuming steady returns and consistent contributions. Additionally, any capital gains from stock price increases would further amplify this growth, potentially making the portfolio even more robust. I have a calculator on my website that can help you do these kinds of calculations and play around with the inputs and number variables however you like. You can check it out here. Common mistakes to avoid. Chasing high yields. Stocks with extremely high yields may face financial difficulties or unsustainable payouts. Balance yield with stability and growth potential. Neglecting research. Blindly investing in dividend stocks without understanding the company's fundamentals can lead to losses. Always perform due diligence before buying anything. Lack of patience. Dividend investing requires time and discipline. Avoid the temptation to sell prematurely or switch strategies frequently. In conclusion, how much you need to start dividend investing depends largely on your goals and financial situation. With fractional shares and low-cost brokers in the UK, starting with a small amount is entirely feasible. However, a more significant initial investment allows for quicker results and the potential for better diversification. Ultimately, the key to success in dividend investing is consistency. Regular contributions, reinvestment, and patience can turn even modest beginnings into a robust portfolio that provides reliable passive income for years to come. If you liked this video, and if you made it this far, I'm guessing you probably did, then I have some good news for you. I'm giving away my PDF guide to the 10 dividend investing commandments, or the criteria that I use to pick dividend paying stocks, and I'm giving it away to you for free. All you need to do is submit your email in the link below and it'll get delivered to your inbox straight away. Again, that's for free. But that's not the only benefit of joining the email. You also get updates on the almost daily dividend portfolio, interesting stock ideas or news, and special deals and free stuff that I can share with you. Thanks for watching, and I hope to see you on the next video. See you!